Before we begin, it's crucial to understand that the information in this presentation is for educational and entertainment purposes only. I am not a licensed financial advisor, attorney, or certified public accountant. The contents of this video should not be considered as financial, legal, or tax advice. Investing involves risk, including the potential loss of principal. You should always conduct your own thorough research and consult with qualified, licensed professionals before making any investment decisions. Your financial situation is unique, and any choices you make are your sole responsibility. What if I told you that the secret to owning a piece of $100 million apartment complex, a sprawling shopping center, or even a state-of-the-art self-storage facility isn't having $100 million? In fact, what if the key wasn't even having $1 million? For many people, it starts with less than the price of a new car. You drive past these massive construction projects, these towering cranes reshaping the skyline, and you think to yourself, who has that kind of money? Who are these people? You feel locked out. You're doing all the right things, you're saving, you're contributing to your 401k, maybe you even own your own home. But you know deep down that the real wealth, the kind of generational wealth that changes your family's future, is being built in those giant deals you can only see from the highway. You feel like you're playing checkers while the billionaires are playing a completely different game of 3D chess on a board you can't even access. Well, today we are kicking down the door to that secret room. We are pulling back the curtain on the single most powerful structure that allows everyday, regular Americans to pool their resources and invest like the titans of industry. This is the world of investment group partners. And by the time you finish this video, you will not only understand exactly what that means, but you will know the two critical roles that make up every single one of these groups. More importantly, you'll understand the fundamental framework that could potentially unlock an entire universe of investment opportunities you probably thought were completely out of your reach. So let's start with a simple analogy. Imagine the most incredible, delicious gourmet pizza you've ever seen. It's huge. It costs $10,000. It's got imported truffles, rare cheeses, the works. You want a piece of that pizza more than anything. But there's no way you can afford to buy the whole thing yourself. And even if you could, you couldn't possibly eat it all. So what do? You find a bunch of friends who also want a taste. You all chip in. One person, the foodie who knows the chef, organizes the whole thing. They place the order, they handle the money, they go pick it up, and they slice it for everyone. You just put in your share of the cash, and in return you get your slice of that amazing pizza without having to do any of the work. Congratulations! You just participated in an investment group. That giant $10,000 pizza is a massive real estate deal. An apartment building, a mobile home park, a medical office. You are one of the friends who chipped in. And the person who organized it all? They are the other half of the equation. In the professional world, these partnerships have specific names, and understanding them is the absolute foundation of everything. Inside virtually every investment group, there are two distinct types of partners: the general partner and the limited partner. Let's talk about the general partner first. Think of the general partner, or GP, as the captain of the ship. They are the active, hands-on expert. They are the ones with the vision, the experience, and the sweat equity. The GP is the real estate professional who spends months, sometimes years, hunting for the perfect deal. They're the ones digging through hundreds of properties, running complex financial models, and building relationships with brokers to find that one diamond in the rough. When they find it, their work is just beginning. The general partner is responsible for literally everything. They negotiate the purchase price with the seller. They secure the multi-million-dollar loan from the bank. They conduct the due diligence, which means hiring inspectors to check the roof, the plumbing, the foundation, and poring over every line of the property's financial statements to make sure the deal is solid. They create the business plan. Are they going to renovate the units to increase rent? Are they going to add new amenities? Are they going to bring in a new management company to run things more efficiently? Once the deal is closed, the GP manages the entire project. They oversee the renovations, they manage the property manager, they handle the accounting, the legal work, the investor communications, and all the inevitable problems that come up when you own a massive asset. A pipe bursts at 3 a.m.? The general partners team gets the call. Not you. A tenant needs to be evicted? The GP's attorneys handle it, not you. They do all of the heavy lifting. They take on the immense operational responsibility and the day-to-day headaches. They are the active investor. Their job is to execute the business plan and make the investment successful. They bring the expertise, the deal, and the management. But they often have one missing ingredient: all of the capital needed to buy the deal. And that's where the second role comes in, the limited partner. The limited partner, or LP, is the other side of the coin. If the general partner is the captain of the ship, the limited partners are the valued passengers who funded the voyage. The LPs are the individuals just like you, who want to invest in the deal but don't have the time, the desire, or the specialized expertise to find, manage, and operate a 200-unit apartment complex themselves. They are the passive investors. Their primary and often only role is to provide a portion of the required capital. Think back to our pizza analogy. The LPs are the friends who chipped in money for their slice. They didn't have to find the recipe, call the restaurant, or drive across town to pick it up. They just provided the cash. As a limited partner, you are investing with the expert, not becoming the expert. You get the benefit of owning a piece of a high-quality, institutional-grade asset without any of the landlord responsibilities. No tenants, no toilets, no termites. Your life doesn't change. You don't get calls in the middle of the night. You simply invest your capital and let the general partner do all the work. And here's a critically important legal distinction and why they're called limited partners. Your liability is typically limited to the amount of money you invested. This is huge. If something goes catastrophically wrong with the property, say a major lawsuit that exceeds the insurance coverage, the creditors can't come after your personal house, your car, or your savings account. Your risk is capped at your investment. The general partner, on the other hand, often has a much greater level of liability, personally guaranteeing loans and taking on the ultimate responsibility for the project's success or failure. So you have these two essential roles. The general partner brings the deal and the expertise. The limited partner brings the capital. It's a powerful symbiotic relationship. The GP needs the LPs because even the best deal in the world is worthless without the funding to close it. And the LPs need the GP because having money in the bank is great, but it's not going to grow and produce cash flow without being put to work in a great deal run by a professional who knows what they're doing. This structure is the engine of the private investment world. It's how skyscrapers get built. It's how tech startups get funded. And it's how you, a person watching this video, can potentially co-own an asset with a team of seasoned professionals, diversifying your portfolio beyond the typical stocks and bonds and gaining access to a world of investment that has been creating massive wealth for decades. Understanding this GP/LP structure is the first, most crucial step. It's the key that unlocks the door. So now you know the who. You know the two major players on the field. The general partner, the quarterback who finds the deal and runs the plays, and the limited partner, the financial backer who makes the game possible. But this just scratches the surface. Knowing who the players are is one thing. Knowing how they get paid, how the profits are split, and how the entire game is structured is where the real power lies. How exactly does the money flow? When the property starts generating income, who gets the first dollar? When the property is sold for a huge profit years later, how is that pie divided? What are the common fees, the hidden clauses, and the critical terms you absolutely must understand before you even think about investing? That is the multi-million-dollar question, and it's exactly where we are going next. Let's start with the architecture of the deal, the blueprint that dictates who gets rich and how. In the world of high finance, this blueprint has a legendary, almost mythical name: the 2 and 20. You'll hear it whispered in conversations about hedge funds, private equity, and venture capital. It's the industry standard, and understanding it is your first step from being an outsider to an insider. So what is 2 and 20? It's a fee structure, broken into two distinct parts. The 2 is the management fee. The 20 is the performance fee. Let's break them down. The 2% management fee is the cost of keeping the lights on for the general partners. Think of it as their salary. This fee covers the day-to-day operational costs of the fund. The fancy office space, the salaries of the analysts spending thousands of hours on due diligence, the legal teams drafting contracts, the flights to scout properties or meet with company founders. It's the fuel that keeps the engine running, while they search for the investments that will hopefully make everyone a fortune. Now, here's the first critical detail that trips up many new investors. That 2% fee is typically charged not on the money that's been invested, but on the total amount of money you've committed to the fund. Let's make that real. Say a fund is raising $100 million. You decide to invest $1 million. You sign the papers, you're in. In your mind, you're waiting for them to find a deal and put your money to work. But the clock on that 2% fee starts ticking on day one. So you'll be paying $20,000 a year in management fees, even if your $1 million is still sitting in a bank account waiting to be deployed. Why do they do this? The general partners will argue it's necessary. They have to run the business for the entire life of the fund, which could be 10 years or more. They can't wait until year 3 to start paying their team. It ensures they have the resources to find the best deals, not just the fastest deals. While that makes sense, you have to factor it in. This fee is a guaranteed drag on your returns. A small but constant headwind you have to overcome before you even start making a profit. But let's be honest, no general partner gets into this game to get rich off of 2%. The real prize, the life-changing money, comes from the other number, the 20. This is the 20% performance fee, more formally known as carried interest or the promote. This is the GP's share of the profits. This is their grand incentive. It's the carrot that aligns their interests with yours. They don't make the big bucks unless you, the investor, make money first. This is the fundamental promise of the partnership. We win together. But again, the devil is in the details. It's not as simple as the fund doubling its money and the GP taking 20% of the gain. Before they can touch a single penny of that carried interest, a crucial hurdle must be cleared. This is your most important protection as a limited partner. It's called the preferred return, or simply the pref. The preferred return is a minimum rate of return that must be paid out to you, the investor, before the profit sharing begins. Think of it as a promise. We, the general partners, don't get our share of the profits until you've gotten your initial investment back, plus a baseline return on that investment. The industry standard for this hurdle is often around 8% per year. So, let's put this all together and see how the money actually flows when a deal is successful. This sequence of payments is called the capital waterfall, and it's a concept you absolutely must understand. Imagine you invested $1 million into a real estate deal. After 5 years, the GP sells the property, and the total proceeds are $2 million, a fantastic outcome. Your $1 million investment has created $1 million in profit. How is that $1 million profit pie divided? The waterfall has distinct tiers. First, and most importantly, is the return of capital. Before anyone talks about profits, the first $1 million from that sale comes right back to you. Your initial investment is made whole. This is step 1 always. Second comes the preferred return. You get paid your 8% pref for the time your money was tied up. Let's keep the math simple and say over the 5 years, that 8% preferred return adds up to $400,000. So, after you get your $1 million back, the next $400,000 from the sale proceeds also goes to you. At this point, you've received $1.4 million in total. You've gotten your capital back and you've cleared your hurdle. Only now, after you've been made whole and received your preferred return, can the general partner start to participate in the profits. This is where it can get a little more complex with something called a catch-up clause. Many agreements are structured so the GP can catch up to their 20% share. In our example, a profit of $400,000 was paid to you as the pref. The GP will argue that they deserve 20% of all profits. So, the next slice of the remaining cash might go 100% to the GP until they have caught up. To get to a 20% share of the $400,000 profit you received, they would need to receive $100,000. So, the next $100,000 of the proceeds goes directly to the GP. Now the waterfall reaches its final tier. We started with a $2 million sale. You got your $1 million back. You got your $400,000 pref. The GP got their $100,000 catch-up. That's $1.5 million accounted for. There is still $500,000 of profit left on the table. This is where the famous 80-20 split finally happens. 80% of that remaining $500,000, which is $400,000, goes to you, the limited partner. 20%, $100,000, goes to the general partner. Let's look at the final tally. You invested $1 million. You received your million back, plus $400,000 in pref, plus another $400,000 from the final split. Your total return is $1.8 million. The general partner, for their work, received $100,000 from the catch-up and $100,000 from the final split, for a total of $200,000. That is the 80-20 split in action. Your total profit was $800,000, and the GP's was $200,000. It seems complex, but that structure is designed for one reason: alignment. The GP is heavily incentivized to not just clear the 8% hurdle, but to blow past it, because that's where their real payday lies. And what happens if a fund has a big win early on? The GP takes their 20%, but then a later investment in the same fund loses a lot of money. That's where another critical term comes in: the clawback. A clawback provision forces the general partner to give back previously distributed performance fees to cover later losses, ensuring that they are only truly rewarded based on the overall performance of the entire fund, not just a few lucky early wins. It's a vital safety net for investors. Now, the 2 in 20 model is the classic, but the world is changing. Increased competition has led to more investor-friendly terms. You might see 1 in 15, or fee structures that scale down as the fund gets larger. Some funds waive management fees entirely after they've invested all the capital. The key isn't to memorize one structure. The key is to know what to look for in the fund's legal documents, the limited partnership agreement, and to understand precisely how and when everyone at the table gets paid. So now we understand the who, the L piece and the G piece, and we understand the how much, the waterfall and the fee structure. But what about the what? What are these general partners actually doing with your money? Are they buying skyscrapers in Manhattan, funding the next billion-dollar tech startup, or taking over struggling companies and turning them around? The strategy they choose is the engine of your returns, and it dramatically changes the risks you take. And breaking down those core strategies, that's where we're headed next. Let's start with the big one, the one you hear about in Silicon Valley stories and see in movies: venture capital or VC. Think of a venture capitalist as a professional gambler, but instead of a poker table, their casino is the future of technology and innovation. Their strategy is to plant 1,000 seeds, knowing full well that most will never sprout. They water everything, but they're searching for 1 or 2 seeds that will grow into giant, world-changing redwood trees. These are the Ubers, the Airbnbs, the Googles of the world. A VC firm invests in companies at the earliest, most fragile stages. We're talking about 2 people in a garage with a brilliant idea, a half-written piece of code, and a PowerPoint deck full of dreams. These companies often have 0 revenue, 0 customers. They are pure, unadulterated potential. The bet isn't on a proven business model. The bet is on the founder's vision and the sheer size of the market they're trying to disrupt. A VC fund might invest in 50 different startups. 40 of them might go completely bankrupt, losing every single dollar. 9 might do okay, maybe returning the original investment or a little more. But one of them might become the next multi-billion-dollar giant. And the return on that single winner, that 100x or even 1000x return, is so massive that it pays for all the other failures and still generates incredible profits for the fund's investors. This is the power law of venture capital. They aren't looking for base hits. They are swinging for a grand slam every single time. And they don't just write a check and walk away. They take a seat on the board of directors. They become mentors, connectors, and sometimes the toughest critics. They help hire key engineers, introduce the founders to their first major clients, and guide them through the treacherous journey from a simple idea to a real functioning company. It's the highest risk, highest reward game in the investment world. Now let's shift gears completely and move from the garage to the boardroom. Let's talk about private equity or PE. If venture capitalists are planting seeds, private equity firms are the master home flippers of the corporate world. They don't look for tiny startups. They look for big, established, and often slightly boring companies. Think of a 50-year-old manufacturing company, a regional grocery chain, or a well-known brand of clothing that has seen better days. The PE firm sees a solid house with good bones, but it's outdated. The plumbing is old, the kitchen needs a remodel, and the curb appeal is terrible. So they buy the whole house. Their signature move is something called a leveraged buyout or LBO. This is a key term to understand. Leveraged simply means using a lot of borrowed money, debt, to make the purchase. They might put down 30% of their own fund's money and borrow the other 70% from banks. Why? Because using debt magnifies their potential returns. It's like getting a mortgage to buy a rental property. If the property value goes up, your return on your down payment is huge. Once the PE firm owns the company, the renovation begins. This isn't a coat of paint. This is a gut renovation. They might bring in a whole new management team, a new CEO with a reputation as a turnaround artist. They'll pore over the finances, cutting waste and inefficiencies. They might sell off unprofitable divisions of the company to focus on the core business. They might invest heavily in new technology to streamline operations or modernize the supply chain. The goal is to make the company leaner, more efficient, and dramatically more profitable over a period of about 3 to 7 years. And then comes the flip. They need to sell the renovated company to realize their profits. This is called the exit. They might sell it to a bigger company in the same industry. They might sell it to another private equity firm. Or, in a grand finale, they might take the company public again through an initial public offering, or IPO, selling shares to the public on the stock market. The entire strategy is to buy, improve, and sell. It's a hands-on, often brutal, but incredibly powerful way to create value where others saw none. So we have VC for brand new ideas and PE for established companies needing a makeover. But what about the space in between? What about a company that's already successful, already growing fast, but needs a massive injection of capital to hit the next level? That's where growth equity comes in. Think of this as the rocket fuel for corporate teenagers. This isn't a baby startup, and it's not a tired old company. This is the star athlete of the business world. It's a company that has found its footing, has a proven product, a loyal customer base, and is already profitable. But they're at a critical inflection point. Maybe a software company that dominates the West Coast wants to build a national sales force to take on the whole country. Or a popular e-commerce brand needs $50 million to build a massive new distribution center to keep up with demand. They're growing, but they need a huge amount of cash to fund that next giant leap. They don't want to sell the entire company like in a private equity deal, and they're too mature to give up the kind of control a venture capitalist would demand. So a growth equity fund steps in. They provide the $50 million, but instead of buying the whole company, they'll take a significant minority stake, say 15 or 20%. They get a board seat, not to run the company but to act as a strategic advisor. They use their network to help the company expand, to navigate complex challenges, and to prepare for an eventual IPO or sale. They are pouring gasoline on an already burning fire to create an inferno of growth. It's less risky than venture capital because the business is already proven, but it offers higher growth potential than a typical private equity deal because the company is still in its hypergrowth phase. These three, venture capital, private equity, and growth equity, are the main pillars. But the world of investment groups is vast. You also have specialized players, the special ops teams of finance. For instance, you have hedge funds. While they often trade in public stocks, many operate as private investment groups. Their defining feature is their flexibility. They are the chameleons. They can bet on stocks going up, bet on them going down by shorting, use complex derivatives, and invest in anything from currencies to commodities. Their goal is often to generate absolute returns, meaning they aim to make money whether the overall market is booming or crashing. Then you have the true specialists like distressed debt funds. These are the corporate paramedics. They rush in when a company is on the brink of death, in or near bankruptcy. They don't buy the company's stock, which is often worthless. They buy the company's debt for pennies on the dollar from lenders who have lost all hope and just want to get something back. The distressed debt fund then gets a seat at the table during the bankruptcy or restructuring. Their bet is either that they can help nurse the company back to health, making the debt valuable again, or that the company's assets, its factories, patents, real estate, when sold off piece by piece, are actually worth more than what they paid for the debt. It is an incredibly complex, high-stakes game played by some of the sharpest minds in finance. So you see, it's not just one thing. An investment group strategy is its DNA. It dictates everything. A VC is hunting for a unicorn in a field of startups. A PE firm is a corporate surgeon, cutting and restructuring a mature business. A growth equity investor is a booster rocket for an already successful company. Understanding this strategy is the first and most critical step, because it tells you the story of where your money is going, the level of risk being taken, and the kind of journey it's about to go on. But this brings up a crucial question. We've talked about the what, the strategies. But what about the who? Who are the actual people making these billion-dollar decisions? And on the other side, who are the people and institutions providing all this cash? This leads us to the fundamental structure of every single one of these groups. A critical partnership between two distinct players. The masterminds and the money, the brains and the bankroll. And understanding that relationship, that is the absolute key to unlocking how this entire world works. So let's give these two players their proper names. In the world of private investments, they're not called masterminds and bankrolls. They're called the general partner and the limited partner, the GP and the LP. And once you truly understand the dance between these two, you'll see it everywhere. From a 3-person team flipping a house in Phoenix, to a Wall Street titan raising billions for a global infrastructure fund. Let's start with the general partner, the GP. This is the engine, the quarterback, the one in the trenches, covered in mud, making the plays. The GP is the active, hands-on manager of the entire enterprise. Their job is an absolute grind, a marathon of high-stakes decisions. They are the ones who originate the entire idea. They're the real estate expert who spends 6 months driving through a specific submarket in Austin, Texas, building relationships with brokers, analyzing demographic shifts, and identifying that one specific 150-unit apartment complex that's been mismanaged for a decade and is ripe for a turnaround. They're the venture capitalist who meets with 100 different software startups, digging through their code, grilling their founders, and finding that one company with the unique technology and the obsessive team that could actually change an industry. The GP does the dirty work. This is called due diligence, and it's where most deals die. They're the ones paying lawyers to comb through 1,000 pages of title reports and zoning regulations. They're hiring engineers to inspect the foundation of a building and assess the state of a 40-year-old boiler. They're building fantastically complex financial models in Excel, stress testing every assumption. What if interest rates go up? What if a major employer leaves town? What if our construction costs are 20% higher than we planned? They have to think of everything that could possibly go wrong because once the deal is done, it's their neck on the line. And if, after all that, the deal still looks good, the GP's job has only just begun. Now they have to create the business plan. This isn't just a vague idea. It's a meticulously detailed, multi-year strategy. We're going to buy this apartment complex for $10 million. We will spend $1.2 million on renovations, new kitchens, new flooring, new paint. We'll improve the landscaping and add a dog park. This will allow us to raise rents by $225 per unit over the next 24 months. We'll bring in a new, more efficient property management company, cutting operating expenses by 8%. By year 5, the property's net income will have increased by 40%, making it worth $16 million, at which point we will sell it. That's the kind of granular detail they live in. And with this plan in hand, they go out and do the hardest job of all. They raise the money. They pitch their deal to the limited partners. They put their reputation, their track record, and their credibility on the table and say, "Trust me, I have the vision and the expertise to execute this plan and make us all a great return." Once the money is raised and the deal is closed, the GP manages the entire project. They are the CEO of this single investment. They hire the contractors, manage the budgets, deal with the city permits, handle the marketing, and make the hundreds of daily decisions required to keep the plan on track. They are fully, completely, and personally responsible for the success or failure of the venture. For this immense effort and risk, the GP is compensated. They typically earn an acquisition fee when they buy the asset, an ongoing asset management fee to keep the lights on, but the real prize, the grand slam, is what's called carried interest or the promote. This is a share of the profits, but, and this is critical, they only get it after the investors, the limited partners, get their initial investment back plus a preferred return. We'll dig into those numbers later, but the core principle is simple. The GP only gets truly rich if their investors get rich first. Their interests are aligned. Now let's flip the coin and look at the other side of the partnership. The limited partner, the LP. If the GP is the pilot, the LP is the first-class passenger. The LP is the passive investor. They are typically successful individuals, doctors, lawyers, business owners, tech executives, or institutions like pension funds or endowments. They have capital they want to put to work. They want the high returns and diversification that private investments can offer, but they have two problems. They lack the specialized expertise to find and manage these deals themselves, and more importantly, they lack the time. A heart surgeon finishing a 12-hour shift does not have the energy to start analyzing commercial lease agreements. A software engineer at Google isn't going to spend her weekend vetting roofing contractors. They want to invest their money with an expert they trust, and then get back to their own demanding careers and lives. Their role is primarily to provide the capital. That's it. They write the check. And in exchange for that capital, they receive two incredibly powerful benefits. The first is in their name, limited. Their involvement is limited. They are not expected to, nor are they allowed to, participate in the day-to-day management of the project. The GP handles everything. The second, and far more important benefit, is limited liability. This is a legal shield of immense importance. An LP's financial risk is limited to the amount of money they invested. If they invest $100,000 into an apartment deal, the absolute most they can ever lose is that $100,000. If the project goes completely bankrupt, if a lawsuit hits, if creditors are banging down the door, they cannot come after the LP's personal assets. They can't touch their house, their savings, or their retirement accounts. That risk, that unlimited liability, falls squarely on the shoulders of the general partner. The LP's reward structure reflects their role as the capital provider.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
They are first in line to get paid. They receive the majority of the profits from the deal, often 70 or 80%, after getting their initial investment back. They get the benefits of property ownership, like cash flow and appreciation, without any of the headaches of being a landlord. They are leveraging the GP's time, expertise, and risk-taking to grow their own wealth. So you see, it's a perfectly symbiotic relationship. It's a beautiful financial machine built on a simple premise. Each party provides what the other one lacks. The general partner has the deal, the vision, the expertise, and the willingness to take on immense operational and legal risk, but they don't have the millions of dollars in capital required to bring it to life. The limited partners have the capital, but they lack the time, the specialized knowledge, or the desire to take on the day-to-day burdens of management and unlimited liability. The GP brings the opportunity. The LPs bring the fuel. One cannot function without the other. The GP needs the LP's money to close the deal. The LP needs the GP's expertise to generate a return on that money. It's a classic partnership where 1 + 1 = 3. Together they can achieve something: buy a hotel, fund a biotech startup, develop a shopping center, that neither could ever hope to accomplish on their own. But this perfect-sounding partnership is built on a foundation of trust that is then codified into a brutally specific legal framework. How do you actually structure this deal on paper? How do you write the rules of the game to ensure the GP is motivated but can't just take the money and run, and the LPs are protected but can't meddle in the project and screw it up? It all comes down to the legal entity they choose to form and the operating agreement that governs their entire relationship. And that document, that is the constitution for their entire shared universe. Let's zoom in on that word, constitution, because that's exactly what it is. It's not just a stack of legal papers you sign and file away. It is the foundational text that dictates power, protects rights, and outlines the entire system of governance for your investment. Get it wrong, and you're building a skyscraper on a foundation of sand. Get it right, and you've created a fortress that can withstand almost any storm the market or human nature can throw at it. The most common, most flexible, and frankly the most brilliant structure for this kind of venture in the United States is the limited liability company, or LLC. You've heard the term, but do you really understand the power it holds? The LLC is a legal masterpiece. It's a hybrid entity that takes the best parts of a corporation and the best parts of a partnership and merges them into one elegant solution. Its first superpower is right in the name: limited liability. This is the bedrock of modern investing. Let's go back to Sarah, our go-getter general partner, and her group of investors. They buy that 50-unit apartment building. 6 months in, a freak winter storm causes a series of pipes to burst on the 3rd floor, leading to catastrophic water damage in a dozen units below. The repairs are going to cost hundreds of thousands of dollars, far more than the insurance deductible. Even worse, a tenant slips on a wet floor during the chaos, suffers a serious injury, and sues the ownership group for negligence for $1 million. Now, if Sarah and her partners had just formed a simple general partnership, basically a handshake deal, this lawsuit would be an absolute nightmare. The court wouldn't just look at the money in the business's bank account. It would look past the business, directly at the personal assets of every single partner. That means Sarah's home, David's retirement account, Dr. Evans's stock portfolio, the tech couple's savings for their kids' college. It could all be seized to satisfy the judgment. Their entire personal financial lives would be on the line because of a burst pipe. That is a terrifying amount of risk. But because they wisely formed an LLC, a legal person was created, separate and distinct from the owners. The LLC is like a financial firewall. The lawsuit can only attack the assets owned by the LLC, namely, the apartment building itself and the cash in its business bank account. The creditor cannot cross that firewall to get to Sarah's house, or the investor's personal savings. Their liability is limited to the amount of money they invested in the deal. This protection is not a small detail. It is the entire reason people can confidently pool their money to invest in large assets without betting their entire personal future on the outcome. The LLC's second superpower is pass-through taxation. This sounds complicated, but it's a beautifully simple concept that saves investors a fortune. A traditional C corporation faces what's called double taxation. The corporation earns a profit and pays corporate income tax on it. Then, when it distributes the remaining profits to its shareholders as dividends, the shareholders have to pay personal income tax on that same money. The same dollar gets taxed twice. The IRS loves it. Investors hate it. An LLC by default avoids this completely. It's a pass-through entity. The LLC itself pays no federal income tax. Instead, the profits or the losses flow directly through the company to the individual members. Sarah, David, and all the limited partners simply report their share of the building's net income on their personal tax returns and pay tax at their individual rates. The money is only taxed once. It's a massively more efficient way to structure the finances, putting more money back into the pockets of the people who actually took the risk. But the true genius of the LLC, the thing that makes it perfect for investment groups, is its incredible flexibility. This is where the operating agreement, that constitution we talked about, comes into play. An LLC's operating agreement is a completely customizable document. It allows you to write your own rules. It lets Sarah and her partners define their universe with surgical precision. This document is where the theoretical roles of general partner and limited partner are made real and legally binding. It will state, in no uncertain terms, that Sarah is the managing member, vested with the authority to run the day-to-day operations. It will define what she can and can't do without a vote. For example, it might say Sarah can approve any single expense up to $10,000, but anything more requires approval from David, the other GP. It will state that the limited partners have absolutely no management authority and no ability to interfere with daily business. This legally enforces the exact dynamic they need: a skilled operator at the helm, and passive investors who are protected from both liability and their own worst instincts to meddle. But the operating agreement goes so much deeper. It's the playbook for every possible scenario. Let's break down the 5 critical sections you'll find in every well-drafted agreement. First, capital contributions. The agreement spells out precisely who put in what amount of money. But more importantly, it answers the question, what happens when we need more money? What if that burst pipe repair costs $200,000 and there's only $50,000 in the bank? The agreement will have a clause for capital calls, defining the process for asking the partners for more money. It will also define the brutal consequences for any partner who fails to contribute their share. Maybe their ownership stake gets diluted, or maybe the other partners can buy them out at a steep discount. This isn't about being mean. It's about ensuring the project's survival when things go wrong. Second, profit distributions. This is the part everyone cares about, and it's almost never a simple straight-line split. In sophisticated deals, money flows out in a sequence called a distribution waterfall. It's designed to protect and incentivize everyone in a specific order. The first water out of the spout goes to the limited partners until their entire initial investment, their capital, is returned. They get their money back first. The second gush of water is the preferred return. The limited partners might receive, say, the first 8% of annual profits on their invested capital, before the general partners get anything. This is their reward for putting up the cash. Only after the LPs have gotten their capital back and their preferred return does the waterfall cascade down to the next level, which is usually a catch-up for the general partners. Finally, once all those benchmarks are met, the remaining profit is split according to a new ratio. This final split is where the GPs get their promote or carried interest, a disproportionately large share of the profits, maybe 20% or 30%, as their grand prize for finding, managing, and executing a successful investment. This waterfall structure is the engine of the entire deal. Third, voting rights. The agreement meticulously defines what constitutes a major decision. Day-to-day stuff is left to Sarah. But what about selling the entire property? Or refinancing the loan and pulling out millions in equity? Or changing the core business plan? These are major decisions. The agreement will state that these actions require a vote, and it will specify the threshold for approval. Maybe a supermajority of 67% or 75% of the ownership interests. This gives the passive investors a crucial say in the handful of decisions that can fundamentally alter their investment, providing a vital check on the GP's power. Fourth, roles and responsibilities. This section goes beyond just naming a manager. It gets granular. It defines the GP's duties: to provide quarterly financial reports, to maintain the property to a certain standard, to communicate material events to the investors promptly. It turns vague expectations into contractual obligations. And fifth, the exit strategy. People's lives change. What happens if one of the limited partners gets divorced and a court orders their assets to be split? What if someone dies or declares bankruptcy, or simply wants to cash out early? You can't just have shares of a private LLC being sold on Craigslist. The operating agreement contains buy-sell provisions that control this. It typically gives the other members of the LLC the right of first refusal to buy the exiting partner's shares, and it dictates the exact process for determining a fair price, whether it's a predetermined formula or based on a third-party appraisal. This clause is the ultimate safety net. It protects the remaining partners from suddenly finding themselves in business with a stranger, a hostile ex-spouse, or a bankruptcy trustee. This document, this operating agreement, is the difference between a professional investment and a group of friends gambling their money. It is a pre-negotiated solution to every difficult conversation you might have in the future. It forces everyone to confront the tough, what-if scenarios up front, while everyone is still friendly and optimistic. It transforms a loose collection of individuals into a single, focused, and resilient investment vehicle, ready to navigate the complexities of the market. So now you have this ironclad operating agreement, this legal machine built for one purpose: to make money and protect everyone involved. But a machine, no matter how perfectly engineered, is just a pile of metal and paper without a skilled crew to run it. The single biggest factor that determines whether your investment group soars to incredible heights or crashes and burns in a spectacular fireball of lawsuits and broken friendships isn't the deal. It isn't even the market. It's the people. It's the who. Who is finding the deals? Who is running the numbers? Who is managing the asset? Who is putting up the cash? Get the human element right and you can navigate almost any storm. Get it wrong and you'll sink in a calm harbor. In the world of professional investment, especially in assets like real estate syndications or private equity, the team is typically broken down into two major categories. Understanding these two roles is like understanding the difference between the quarterback and the owner of an NFL team. Both are essential to winning the Super Bowl, but they play fundamentally different games. These roles are the general partner and the limited partner. Let's start with the general partner, or the GP. Think of the GP as the captain of the ship, the lead singer of the band, the director of the movie. This is the active, hands-on operator. The GP is the one who does the work. All of it. They are the ones spending a year hunting for the perfect 100-unit apartment complex in a growing market. They're the ones flying to Phoenix to walk the property, kicking the tires, checking for cracks in the foundation, and smelling for hidden problems. They're the ones building the complex financial models, stress testing the assumptions, and creating a 50-page business plan that details exactly how they're going to take this B- property and turn it into an A+ cash flowing machine over the next 5 years. The general partner is the one who negotiates with the seller, battles with the lawyers, and personally signs on the massive multi-million-dollar loan from the bank. That's a key point. The GP often takes on the primary liability. When you're dealing with big assets, the bank wants a person, a warm body with skin in the game, to be on the hook if things go sideways. That person is the GP. They are the ones who get the 3 a.m. phone call when a water main breaks and floods the first floor. They are the ones responsible for executing the renovation, for managing the property management company, for handling investor communications, and ultimately for selling the asset at a profit. It is an all-consuming, high-stakes, high-stress job. Because they do all the work and take on the lion's share of the risk and liability, the general partners are compensated differently. They typically earn fees for acquiring and managing the asset, but the real prize is something called carried interest, or the promote. This is their disproportionate share of the profits. For example, a common structure might see the profits split 70-30, with 70% going to the investors and 30% going to the GP team. The GP earned that extra slice of the pie because without their expertise, their hustle, and their willingness to sign on that loan, the deal would have never existed in the first place. They are the engine. Now, on the other side, you have the limited partners, or the LPs. If the GP is the engine, the LPs are the high-octane fuel. The LPs are the capital partners. They are the investors who provide the majority of the equity needed to purchase the asset. They are doctors, lawyers, engineers, business owners, and everyday people who have saved and invested wisely, and now they want to put their capital to work in a way that's more passive. And passive is the magic word here. A limited partner's primary job is to perform their own due diligence, not on the property itself, but on the general partner. They need to vet the team. Do these GPs have a track record? Do they have experience in this market with this type of asset? Is their business plan realistic? The LP's job is to ask the tough questions up front, read every word of the investment summary, and then if they feel confident, write a check. And that's where their active involvement largely ends. From that point on, they are passive investors. They don't manage tenants. They don't oversee renovations. They don't deal with busted pipes. Most importantly, their liability is limited to the amount of their investment. If the deal goes completely south and the bank forecloses, the LPs lose their initial investment, but the bank cannot come after their other assets. They can't come for your house, your retirement account, or your kid's college fund. That liability shield is the fundamental trade-off. You give up control and a larger piece of the profit in exchange for passivity and protection. LPs get regular updates, they receive their share of the cash flow checks, and at the end of the project they get their initial capital back plus their share of the profits. It's a powerful way to build wealth without taking on a second full-time job as a real estate operator. Now this GP/LP structure is the gold standard for large, formal syndications. But what if you're just starting out? What if it's just you and 4 friends who want to buy a duplex together? You probably won't use the formal titles of general partner and limited partner, but the functions still need to be filled. Every successful investment group, no matter how small or informal, needs to have its bases covered. You need to assemble your own A-team, and it's critical to identify who is playing what role. First, you need the deal finder. This is your group's hunter-gatherer. This person is obsessed with the hunt. They're on Zillow and LoopNet every morning before they've had their coffee. They have every real estate broker in a 50-mile radius on speed dial. They thrive on networking, on finding those off-market deals, the hidden gems that nobody else knows about. Without a deal finder, your investment group is just a social club with a bank account. They generate the opportunities. Second, you need the analyst. This is the numbers guru, the spreadsheet wizard, the voice of cold, hard, dispassionate reason. The deal finder might fall in love with the property's charm or potential, but the analyst is the one who strips it down to the numbers. They underwrite the deal, projecting income, expenses, vacancy rates, and renovation costs. They ask the tough questions. Are these rent projections realistic? Is our repair budget high enough? What happens if interest rates go up by 2%? The deal finder brings the opportunity to the table, but the analyst tells you if it's a winning hand or a trap. They protect the group from its own optimism. Third, you need the capital raiser or the connector. This role is part storyteller, part relationship manager. This person might not be the one finding the deal or running the numbers, but they are brilliant at communicating the vision. They can take a complex financial model and explain it in a simple, compelling way that gets other people excited. They are the ones who can reach out to their network, build trust, and bring in the necessary funds to close the deal. After the deal is closed, they are also the primary point of contact for the other partners, ensuring everyone is kept in the loop with clear, consistent communication. And finally, you need the asset manager. This is the post-purchase operator. Once the deal is closed, the party is over and the real work begins. The asset manager is the one who executes the business plan. They hire and oversee the property manager. They manage the renovation project, making sure it stays on time and on budget. They monitor the property's financial performance month after month, making adjustments as needed to maximize returns. This person turns the potential energy of the deal, captured in the analyst's spreadsheet, into the kinetic energy of actual cash flow and appreciation. In a small group, one person might wear multiple hats. Your deal finder might also be your analyst. Your capital raiser might also take on the asset management role. That's perfectly fine. But the danger lies in not consciously assigning these roles at all. The danger is when everyone assumes someone else is handling it. That's how you end up with a group where everyone thinks they're the ideas person, and nobody is actually doing the work. The key is brutal self-awareness. Know what you're good at, and more importantly, know what you're not good at. If you're a people person who can sell ice to an Eskimo, be the capital raiser. If you love the thrill of the hunt, be the deal finder. If you find peace in the elegant logic of a spreadsheet, for God's sake, be the analyst. Build a team that complements your skills, that fills in your gaps. You're not trying to clone yourself. You're trying to build a championship roster where every position is filled by a pro. This structure, this deliberate assignment of roles and responsibilities, is what separates the professionals from the amateurs. It transforms a hopeful ambition into a focused business operation. So you've mapped out the roles you need to fill on your team. You know you need a hunter, an analyst, a connector, and an operator. The blueprint is there. But where in the world do you find these people? How do you go about recruiting your A-team, and once you find them, how do you know you can trust them with your money and your future? How do you separate the real players from the pretenders? That's the million-dollar question, and it's exactly what we're breaking down next. Alright, let's get down to brass tacks. You've identified a potential investment group, a sponsor, a team that seems to have it all together. Their website is slick, their marketing materials are polished, and their projected returns look like a dream come true. But here's the cold, hard truth. A glossy brochure has never saved an investment from a bad operator. The single most important due diligence you will ever do is not on the property, it's not on the market, it's on the people who will be in control of your money. A great sponsor can salvage a mediocre deal, but a bad sponsor will find a way to sink a fantastic one. Think of it like this. You're boarding a ship for a long voyage. Would you spend more time inspecting the fancy paint job on the hull? Or would you spend it interrogating the captain about their experience navigating through storms? The answer is obvious. The sponsor is your captain. So how do you vet them? How do you look past the sales pitch and see the real operator? First, you have to dissect their track record like a forensic accountant. And I don't mean the highlight reel they present to you. Every sponsor will show you their home runs. They'll flash charts with big, beautiful numbers from their most successful deals. That's marketing. You need to ask for the B-sides, the director's cut, the deals that didn't go perfectly according to plan. Ask them this direct question. Can you walk me through a deal that faced significant, unexpected challenges, and how you navigated it for your investors? A seasoned, honest operator will light up. They'll have a story about a surprise plumbing disaster, a sudden property tax hike, or a major tenant going bankrupt. They'll tell you how they communicated the problem to investors, what steps they took to mitigate the damage, and what the final outcome was. They'll be proud of how they handled the storm. A pretender, on the other hand, will get defensive. They'll dodge the question, claim every deal has been perfect, or give you a vague, meaningless answer. That's a giant flashing red flag. You're not looking for someone who's never failed. You're looking for someone who has the experience and integrity to handle failure when it inevitably arrives. And while you're at it, ask the bravest question of all. Have you ever lost investor capital on a deal? The way they answer this tells you everything about their character. Second, run a real-time communication test. Before you even think about wiring a single dollar, observe how they communicate with you as a potential investor. Send them an email with a list of 10 specific, detailed questions about their strategy, their fees, their assumptions in the pro forma. Then start a stopwatch. How long does it take for them to respond? When they do respond, is it a thoughtful, comprehensive answer that addresses every single one of your questions? Or is it a canned one-sentence reply that directs you back to their website? Do they offer to get on a call to discuss your questions in more detail? Remember, this is the dating phase. This is when they are trying their hardest to impress you. Their communication right now is the absolute best it will ever be. If they are slow, dismissive, or unclear now, I guarantee you it will be 1,000 times worse when a real problem hits the property and your money is on the line. Imagine a pipe bursts at 2 a.m., flooding 3 units. Do you want the sponsor who takes 3 days to answer an email, or the one who is proactive, transparent, and treats your questions with respect? The test starts now, not after you've signed the documents. Third, you have to verify their skin in the game. This is a critical concept. It means how much of their own personal, hard-earned cash the general partners are investing in the deal right alongside you. This is the ultimate alignment of interests. If the sponsor has a significant amount of their own capital at risk, their motivation to protect the investment skyrockets. They're not just managing your money, they're managing their money. Their sleepless nights will be your sleepless nights. Their wins will be your wins. Ask them directly. How much capital is the GP team personally investing in this deal? Be wary of vague answers. You want a specific dollar amount or a percentage, and it has to be a meaningful number. If a sponsor is raising $10 million from investors but is only putting in $25,000 of their own money, that's not skin in the game. That's a token gesture. It's like a chef opening a restaurant but refusing to eat his own food. You want a sponsor who is eating right alongside you at the same table, because it ensures they care deeply about the quality of the meal. A significant co-investment from the sponsor is one of the most powerful risk mitigation tools you have as a passive investor. Fourth, you need to conduct reference checks on steroids. The sponsor will happily give you a list of 2 or 3 investors who will sing their praises. Call them, but know that you're talking to their biggest fans. The real intelligence comes from digging deeper. Ask the sponsor for a list of all the investors from a deal that has gone full cycle, meaning they bought it, managed it, and sold it. A transparent sponsor will have no problem with this. A secretive one will make excuses. Once you get that list, pick a few names at random and reach out. Introduce yourself as a prospective investor and ask if they'd be willing to share their experience. Ask them the tough questions. How was the communication when things weren't going perfectly? Were there any surprises, good or bad? Did the actual financial performance match the initial projections? Were distributions ever late or suspended? And if so, how was it explained? And the ultimate question: knowing what you know now, would you invest with them again? The answers you get from these unsolicited references are pure gold. This is the unfiltered, unvarnished truth you will never find in a marketing packet. Finally, put them through the what-if gauntlet. This is where you test their foresight and contingency planning. A good operator doesn't just plan for success, they plan for adversity. Turn the interview into a series of hypothetical scenarios. Ask them, what is your plan if the property manager you've selected dramatically underperforms in the first 6 months? What if a major recession hits right after we close, and occupancy drops by 15%? What if your renovation budget proves to be 30% too low because of unforeseen issues? What if the floating rate debt on the property skyrockets because the Fed raises interest rates 4 times in a year? You're not looking for a magic answer that solves all these problems. What you're looking for is a calm, logical, and experienced response. You want to hear them say things like, "That's a great question. In our underwriting, we've already stress tested for that scenario. Here's our primary plan, and here's our backup plan." A seasoned professional has already thought through these nightmares. They have contingency funds baked into the budget. They have relationships with multiple contractors and property managers. They have a plan. An inexperienced operator will be flustered. They'll give you a deer-in-the-headlights look because they've only ever planned for the best-case scenario. You make your money in real estate by navigating the challenges, and you need a captain who has already charted the course through the stormiest seas. This vetting process, the track record deep dive, the communication test, verifying skin in the game, the real reference checks, and the what-if gauntlet, this is your shield. It's what protects you from the hype and connects you with true professionals. Once you've done this, once you've found a sponsor who passes these tests with flying colors, you've found someone you can begin to trust. You've vetted the jockey, but even with the best jockey in the world, you still need to understand the horse and the rules of the race. And those rules are all laid out in the legal documents that bind you and the sponsor together. The next step is to move from vetting the people to dissecting the paperwork, and it all starts with a dense, intimidating, and critically important document called the Private Placement Memorandum. This is where the promises are put into writing, and it's what we're breaking down next. Think of the Private Placement Memorandum, or PPM, as the unread terms and conditions for a life-altering decision. It's the 100-page legal document that stands between you and a potential investment, filled with dense jargon and enough fine print to make a lawyer squint. Most people see it, their eyes glaze over, and they flip right to the signature page. And that is precisely where catastrophic mistakes are made. Because this document isn't a sales brochure. It's the opposite. It's a confession. It is the sponsor group's legally required disclosure of every single thing that could go horribly wrong. And buried within its pages are the clues that separate a grand slam investment from a financial black hole. So what is it, legally speaking? The PPM is a document mandated by the Securities and Exchange Commission, the SEC, for private offerings. Because these deals aren't publicly traded, they don't have the same level of public scrutiny as buying stock in Apple or Google. The PPM is meant to fill that gap. It's designed to provide you, the accredited investor, with all the material information you need to make an informed decision without being misled. But here's the secret you have to understand. Its primary function is to protect the sponsors, not you. It is their ultimate cover your assets document. By disclosing every conceivable risk, from a meteor strike to a global pandemic to their own potential mismanagement, they create a legal shield. If the deal goes south and you try to sue, their lawyers will calmly point to page 47, section 8, subsection C, where that exact risk was spelled out in black and white. When you sign the subscription agreement, you are legally attesting that you read it, you understood it, and you accepted those risks. So how do you read this thing? How do you turn their legal shield into your analytical sword? You dissect it section by section, looking for the story behind the legalese. Let's start with the easy part. The executive summary. This is the first few pages, the Cliff's Notes of the deal. It'll tell you the basics. What property they're buying, how much money they need to raise, the minimum investment, and the sexy projected returns, the IRR, the cash on cash, the equity multiple. It's designed to be exciting. But relying solely on the executive summary is like deciding to marry someone based on their dating profile. It only shows you the good parts. The real character, the real risks are found in the pages that follow. The first section you should flip to after the summary is the one most people skip.
Disclaimer. The information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
Risk factors. This is the horror story section. This is where the sponsor's lawyers get paid to be paranoid. They will list dozens of risks. Your job isn't to be scared off by them. Every investment has risks. Your job is to differentiate between the generic boilerplate risks and the risks that are specific and material to this deal. General economic downturns or changes in interest rates. That's in every PPM. It's boilerplate. But what if you see something like, the local economy is heavily dependent on the Acme Corporation, which has recently announced potential layoffs. Ding ding ding. That's a specific risk. Or, the property requires significant environmental remediation for which the costs are only an estimate. That is a huge red flag. Read every single risk factor. Let your mind run wild with the what ifs. Does the sponsor have a credible plan to mitigate the most significant of these risks? If the risk section seems unusually short or vague, that's also a red flag. It might mean they haven't done their homework. Or worse, they're trying to downplay the real dangers. Next, you dive into the business plan and use of proceeds. This is the how. How, exactly, are they going to generate those returns they promised in the summary? And where is your money actually going? This section should provide a clear, logical narrative. If it's a value-add deal, it should detail the renovation plan. Are they redoing kitchens and baths? How much have they budgeted per unit? Does that budget seem realistic for the current cost of labor and materials in that market? The use of proceeds should be a line item breakdown of every dollar. You'll see the purchase price, but then look closer. How much is allocated to closing costs? To loan fees? To a renovation budget? And critically, how much is being set aside for an operating reserve? This is their rainy day fund. A thin or non-existent reserve is a sign of an overly aggressive, high-risk operator. If a large unexpected repair comes up, or a few tenants move out, a lack of reserves can sink the entire project. You want to see a clear plan, backed by reasonable numbers, not just a vague promise of making improvements. Now we get to the most important part for your wallet: sponsor compensation and fees. This is where you find out exactly how everyone is getting paid. An investment group's fee structure tells you everything you need to know about their priorities and whether their interests are truly aligned with yours. Let's break down the common ones. First, there's the acquisition fee, typically 1 to 2% of the purchase price. This is their payment for finding, negotiating, and closing the deal. Fair enough. Then there's the asset management fee, an ongoing fee for overseeing the investment, usually a small percentage of the property's monthly revenue. This pays for their time managing the big picture. But the real meat is in the profit split, often called the waterfall or promote. This structure dictates how profits are distributed after the property is sold. A common, investor-friendly structure looks something like this. First, all investors get 100% of their original capital back. Second, investors receive a preferred return, let's say 8% per year on their investment. This means the first slice of the profits goes to the investors until they've hit that benchmark. Only after investors have gotten their money back plus their preferred return does the sponsor begin to share in the remaining profits. This is the promote or carried interest. A typical split might be 70-30. 70% of the remaining profit goes to the investors, and 30% goes to the sponsor as their performance bonus. This is a good structure. Why? Because it heavily incentivizes the sponsor to perform well. They don't get their big payday unless you, the investor, get a great return first. What are the red flags here? Look for excessive fees. An acquisition fee of 5%? That's high. Look for fee structures that pay the sponsor a lot even if the deal does poorly. For example, if they get a huge chunk of the profit before you've even received your preferred return, their incentive is just to sell the property, not to sell it for a great price. Their success must be tied directly to your success. If the fee structure is convoluted and you can't easily understand how they're getting paid, that's a problem in itself. Transparency is key. Finally, there's the subscription agreement. This is the last document. It's the actual contract. It's the part you physically sign. By signing it, you are formally agreeing to the terms of the PPM. You are legally declaring that you are an accredited investor, that you have read and understood all the risks, and that you are sophisticated enough to lose your entire investment. There is no ambiguity here. Once you sign this, the "I didn't know" defense is gone forever. Now I know this sounds like a lot. It is. PPMs are written by attorneys to be understood by other attorneys. So here is the single most important piece of advice I can give you. Do not do this alone. Before you ever sign a subscription agreement for a 6- or 7-figure investment, you must hire your own independent securities attorney to review the documents on your behalf. Not the sponsor's attorney. Your attorney. Someone whose only job is to protect you. It might cost you a few $1,000s, but that is the cheapest insurance you will ever buy. They will spot the oddly worded clauses, the non-standard fee structures, and the hidden risks that you would never notice. It's a non-negotiable step for any serious investor. The PPM in the end is the rulebook. It lays out all the risks, all the fees, and all the legal obligations. It's the foundation. But it's only half the story. It tells you the structure of the game, but it doesn't tell you if the sponsor's strategy for winning that game is based on reality or fantasy. For that, we need to move from the legal document to the financial one. We need to analyze the numbers, the projections, and the underwriting. This is where we dissect the pro forma, the spreadsheet where optimistic dreams can turn into financial nightmares. And that's exactly where we're going next. The pro forma isn't just a spreadsheet. It's the financial story of the deal. It's the script for a movie that hasn't been shot yet. And our job as passive investors is to be the toughest, most skeptical movie critic in the world. We have to read that script and decide if it's a blockbuster in the making or a direct-to-video flop. Every number, every assumption, every cell in that spreadsheet is a claim the sponsor is making. Promise. And we have to verify every single one. Let's start at the top line: income. The first number you'll almost always see is gross potential rent, or GPR. This is the absolute maximum amount of money the property could generate if every single unit was rented, every single day of the year, at the full target market rent. It's a fantasy number, a perfect world scenario. The key here is to question that target market rent. Where did the sponsor get that number? Are they just pulling it out of thin air? Or do they have a detailed rent comparability study? This study should show you what similar, competing apartment buildings in the immediate area are actually renting their units for right now. Not last year. Not what they hope to get. What a tenant is paying today for a similar apartment down the street. If a sponsor is projecting a 20% rent bump after renovations, but the renovated comps in the neighborhood only support a 10% bump, you've just found your first massive red flag. The entire foundation of their financial model is built on a lie. Right below that fantasy number, you'll find the reality check, the line for vacancy and credit loss. No property is 100% occupied all the time. People move out, units need to be turned over, and sometimes, unfortunately, tenants don't pay. A sponsor has to budget for this. A typical, conservative assumption might be between 5 and 10%, but this is hyperlocal. In a red-hot market with a housing shortage, maybe it's lower. In a town with a declining population, it needs to be much, much higher. A sponsor who projects a 3% vacancy rate in a market that historically averages 8% isn't being optimistic. They're being reckless with your money. They are artificially inflating the income to make the deal look better than it is. Then you have other income. This is the money from laundry machines, covered parking spots, pet fees, late fees, application fees. This is an area where sponsors can get creative. Scrutinize this. If they're projecting a huge increase in other income, how? Are they adding a new laundry facility? Are they suddenly going to start charging for parking that was always free? Each of these changes can impact tenant retention. You need to ask if these projections are based on historical data from the property or if they are just plugging in numbers to make the deal work on paper. Now let's cross the line to the expense side of the ledger. This is where deals often go to die. Income is sexy, but expenses are what's real. The first major expense is property management. This is usually a percentage of the effective gross income. That's the total rent collected after vacancy. The industry standard is typically between 3 and 6% for a professional third-party manager. If the sponsor's own management company is charging 8 or 10%, you have to ask why. Are they providing a superior service? Or are they just padding their own pockets before you ever see a dime? Next, repairs and maintenance. This is a huge one. How much money is budgeted to fix leaky faucets, repair broken air conditioners, and patch drywall? A common rule of thumb is to budget a certain amount per unit per year, say $500 to $1,000. But this number is totally dependent on the age and condition of the property. A brand new building might get by with a few $100s per unit. A 50-year-old building with original plumbing and electrical? That number needs to be significantly higher. If the budget for a vintage 1970s apartment complex looks the same as a building from 2015, the sponsor is either clueless or hiding something. They're kicking a very expensive can down the road, and it's going to land in your lap. And then we come to the two silent killers of cash flow: property taxes and insurance. These are not small numbers, and they are often the most underestimated. Here's a classic trap. The sponsor uses the current owner's property tax bill in their pro forma. This is a catastrophic mistake. In most states, the property's value is reassessed for tax purposes upon sale. Since the sponsor is buying it for a much higher price than the previous owner paid, the new tax bill is going to be dramatically higher. A sophisticated sponsor will have already talked to the county assessor or a local tax consultant to get a realistic estimate of the post-purchase taxes. If they haven't, they're flying blind, and the deal's profits could be wiped out by that one-line item alone. Insurance is the same story, especially in states like Florida, Texas, or California. Premiums have gone through the roof. The sponsor must have a firm, recent quote from an insurance broker for the property. Using last year's premium is financial malpractice. We've seen deals where an unexpected 50% jump in insurance costs turned a projected profit into an actual loss for the first 2 years. Once you subtract all these operating expenses from the effective gross income, you get the single most important metric in real estate valuation: the net operating income, or NOI. The NOI is the pure, unadulterated profit the property itself generates before you account for any mortgage payments. It's the lifeblood of the investment. Why is it so critical? Because the value of a commercial property is directly tied to its NOI. The formula is simple. Value equals NOI divided by the market cap rate. This means every single dollar you can add to the NOI, either by increasing revenue or decreasing expenses, has a multiplied effect on the property's total value. It's the engine of your returns. But we're not done with expenses. Below the NOI line, there's another crucial category: capital expenditures, or CapEx. This is not for fixing a running toilet. This is for replacing the entire roof, repaving the whole parking lot, swapping out all 30 old HVAC units. These are the big, expensive, long-term projects. The sponsor's value-add plan lives here. They say they're going to spend $5,000 per unit to upgrade the kitchens and baths. Your job is to ask, is $5,000 enough? Have they gotten actual quotes from contractors? Or is it a guess? And more importantly, for that $5,000 investment, they're projecting a $200 a month rent increase. Is that realistic? Will the market in that specific neighborhood actually bear that increase for a unit with new laminate countertops and a coat of gray paint? This is where you have to be a skeptic. We've seen sponsors put high-end finishes into a C-class property in a blue-collar neighborhood. The units looked great, but they sat empty because the target tenants couldn't afford the premium rent. The sponsor didn't improve the value, they just wasted a ton of money. Finally, we look at the debt. How is this whole purchase being financed? You need to know the interest rate. Is it a fixed rate for 10 years, which is safe and predictable? Or is it a variable rate loan that could skyrocket if the Federal Reserve raises rates? That introduces a massive risk. You also need to look at the debt service coverage ratio, or DSCR. This sounds complicated, but it's simple. It's a ratio that shows how many times over the property's net operating income can cover the annual mortgage payment. A lender might require a DSCR of at least 1.25, meaning the NOI is 125% of the mortgage payment. This gives you a 25% buffer. Is the sponsor's projection a healthy 1.4 or 1.5? Or is it a razor-thin 1.2, where a small, unexpected increase in expenses could mean there isn't enough money to pay the bank? This is what financial due diligence is. It's not just reading the sponsor's pretty presentation. It's an interrogation of their numbers. You have to stress test their assumptions. Build your own simple model. What happens if vacancy is 2% higher than they project? What if repairs are 20% over budget? What if they can only get half of their projected rent increase? Does the deal still work? Does it still produce a profit? Or does it completely fall apart? A good deal should still be a decent deal even under moderately stressful scenarios. A fragile deal, one that only works if everything goes perfectly according to plan, is a deal you should run away from. We've torn the deal apart, we've stress-tested the finances, and we've grilled the sponsor. Now comes the final, most important question: how do you actually get paid? We're about to break down the waterfall, the fee structure, and the exact metrics you need to understand to know if you're getting a fair deal, or if you're just funding someone else's payday. That's the final piece of the puzzle. And it all comes down to a single powerful concept: the waterfall. Imagine a series of buckets, one stacked slightly below the other. You pour the profits from the investment into the very top bucket. Once that first bucket is full, it overflows into the second. Once the second is full, it overflows into the third, and so on. This is, in essence, how every single dollar of profit is distributed in a syndicated deal. It's not a free-for-all. It's a precise, legally binding sequence. The very first bucket, the one at the top, is always the same: return of capital. Before anyone sees a penny of profit, the limited partners, the passive investors who put up the money, get every single dollar of their initial investment back. If you put in $100,000, the first $100,000 of profit distributed to you is simply your own money coming home. This is the ultimate safety net. It ensures that the first priority of any deal is to make the investors whole. Only after this bucket is completely full and has overflowed does the real magic begin. The second bucket is called the preferred return, or the pref. This is arguably the most important number for a passive investor to understand. The preferred return is a minimum annual return that the limited partners are entitled to before the general partner, the sponsor, can participate in the profits. Think of it as a hurdle rate. The GP has to clear this hurdle for their investors before they can get their big payday. A typical preferred return in real estate, for example, is somewhere between 6 and 8% per year. So, if the pref is 8%, you, the LP, are owed an 8% cumulative annual return on your investment before the GP can touch the profit share. If the deal only returns 7% one year, that missing 1% rolls over to the next year. The GP doesn't get to share in any profits until your preferred return bucket is filled to the brim with that full 8% average annual return. This powerfully aligns interests. It forces the GP to focus on delivering a solid, baseline return for their investors first. Now, once the LPs have received all their initial capital back, and they've received their full preferred return, the waterfall overflows into the third bucket. This is often a catch-up provision for the general partner. This can be a little confusing, but stick with me. Let's say the profit split is supposed to be 80-20. 80% for the LPs, 20% for the GP. The catch-up allows the GP to receive a larger portion of the profits, sometimes 100% of the profits at this stage, until they have caught up to their 20% share of the total profits distributed so far. It's a mechanism to rebalance the scales and get the split to the intended target before moving to the final stage. And that final stage, the last bucket, is the carried interest split. This is where the remaining profits are divided according to that predetermined ratio, like 80-20 or 70-30. After everyone's capital is returned, after the LPs have their preferred return, and after the GP has caught up, all remaining cash flow is split. This is the home run for the general partner. It's their reward for finding the deal, managing it, and exceeding the initial return targets. So let's make this real. Imagine a deal, a $10 million apartment complex. The GP finds $3 million from limited partners and gets a $7 million loan. The deal has an 8% preferred return and an 80-20 split. For 5 years, the property operates, paying out cash flow to the LPs. Then, they sell it for $15 million. First, they pay back the $7 million loan. That leaves $8 million. What's the first bucket in the waterfall? Return of capital. The $3 million of initial investment goes right back to the limited partners. Now there are $5 million of pure profit left. What's the second bucket? The preferred return. The LPs are owed an 8% return on their $3 million for 5 years. That's $240,000 a year for 5 years, totaling $1.2 million. So, the next $1.2 million from the profit pool goes to the LPs. Now we have $3.8 million left. Next up, the catch-up. The GP needs to catch up to their 20% share. The total profit distributed so far is the $1.2 million from the pref. The GP's 20% share of that would be $300,000. So the next $300,000 from the profit pool goes directly to the GP. Now we have $3.5 million left. This is the final bucket, the carried interest split. This amount is split 80-20. 80% or 2.8 million goes to the LPs. 20% or 700,000 goes to the GP. Let's tally the final score. The limited partners invested 3 million and got back a total of 7 million. Their original 3 million plus 1.2 million in preferred return, plus 2.8 million from the final split. The general partner, who may have invested little to no capital, walks away with $1 million, 300,000 from the catch-up and 700,000 from the split. This is how wealth is created. The LPs more than doubled their money with a passive investment, and the GP was handsomely rewarded for their expertise and execution. But that's not the whole story. The waterfall only deals with profits. What about the costs of running the show? This is where fees come in, and you need to watch these like a hawk. First is the acquisition fee. This is a one-time fee paid to the GP at the very beginning for the work of finding, analyzing, and closing the deal. This is typically 1 to 2% of the total purchase price. On our $10 million deal, that's a $100,000 to $200,000 fee paid to the GP right at closing. This is standard, but it should be reasonable. Second is the asset management fee. This is an ongoing annual fee the GP charges for overseeing the investment. They're hiring the property manager, handling the accounting, sending you investor updates. They are managing the asset. This fee is usually calculated in one of two ways. Either as a percentage of the total assets under management, say 1%, or as a percentage of the gross monthly revenue, say 3 to 5%. This fee is what keeps the lights on for the GP's company. It pays their staff and overhead. It's not profit, it's operational revenue. There can be other fees too. A disposition fee when the property is sold, or a refinancing fee if they get a new loan. The key is transparency. A good sponsor will have all of these fees clearly laid out in the investment documents. A bad sponsor will try to hide them or layer them excessively. This brings us to the final critical question. How do you know if you're getting a fair deal? It comes down to spotting the green flags and red flags in the structure itself. A huge green flag is when the general partner co-invests a significant amount of their own money into the deal, right alongside the LPs. This is called having skin in the game. If a GP puts in 5 or 10% of the total equity, their interests are now perfectly aligned with yours. They feel the pain of a loss and the joy of a win in the exact same way you do. Another green flag is a fair and standard structure. An industry standard preferred return of 6 to 8% shows they're not trying to lower the bar. A profit split of 70/30ths or 80/20ths is also very common and fair. If you see a sponsor offering a structure like this, it shows they're confident they can perform and are willing to play by the established rules of the game. Now for the red flags. Be very wary of a deal with a low or non-existent preferred return. If a sponsor wants to share in the profits from the very first dollar, before you've gotten a minimum return, they are prioritizing their payday over your financial security. Another major red flag is excessive or layered fees. If you see a high acquisition fee plus a high asset management fee, plus a property management fee going to a company the GP also owns, plus a high disposition fee, they might be trying to make their money from fees, not from the performance of the asset. A sponsor should make a living from fees, but they should build their wealth from the profit split. If the fee structure seems to make them rich regardless of the outcome, you should run. Ultimately, everything we've discussed, from the legal structure of an LLC to the intricate details of a waterfall, is all designed to do one thing: align interests. A well-structured partnership isn't about one party winning at the expense of another. It's about creating a system where everyone wins together. The general partner's success is directly and mathematically tied to the success of their limited partners. When you find a sponsor who offers a fair structure, who puts their own money on the line, and who is transparent about every fee and every projection, you haven't just found an investment. You've found a true partner. You're leveraging their time, their expertise, and their network, and in exchange, you're providing the capital that makes the entire enterprise possible. This is the power of investment group partners. It's the engine that allows individuals to participate in deals they could never access alone, and it allows expert operators to scale their vision beyond the limits of their own checkbook. It's a symbiotic relationship built on a foundation of trust, transparency, and a shared goal. Understanding this structure isn't just academic. It's the key that unlocks the door to a whole new world of wealth creation. Get this part right, and you're no longer just an investor. You're part of a team, moving together toward a common victory.
Disclaimer. The information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.